Now that we saw in the previous video what analysis of financial statements means, its uses, objectives, and limitations, now let us see what are the tools and techniques available to an organization for analyzing the financial statements. A company most commonly uses these five tools for analyzing the financial statements, that are comparative statements, common size statements, trend analysis, ratio analysis, and cash flow analysis. These five tools achieve the various objectives that a company may require in order to take various kinds of decisions. Let us discuss each of these techniques in detail. The first tool of analysis is the comparative statements. The name itself suggests that these statements are for comparing a particular information with some other information. Comparative statements are utilized to compare the financial information of two different points of time. Generally, this applies to the items in the balance sheet and the profit and loss account, wherein the items for the current period and the previous period, along with the changes in such two periods, are recorded side by side. The changes in the two periods that are being compared are recorded both in absolute terms and relative terms. How this helps is these statements show the figures in a comparative form for the increase or decrease in the balances, as well as summaries of the various operational activities for different periods. These figures help an organization to ascertain the direction of change and helps in the trend analysis as well. So, in simple terms, the figures of the various items in the balance sheet and the statement of profit and loss for two different periods of time are recorded, and the changes in absolute terms as well as in relation to each other are also recorded in order to enable comparisons between the performance of an organization in two different points of time. Let us now see the steps to be followed in the preparation of these comparative statements. Firstly, the absolute figures in relation to the statements of two distinct points of time which are being compared has to be listed. This helps to make a financial comparison. Next, the figure in the first period has to be deducted from the figure in the subsequent period for every item. The resulting change, which is either an increase or a decrease, has to be indicated in relation to the first period. Finally, the percentage change has to be calculated. When we put this across as a formula, we see that percentage change is equal to the absolute increase or decrease divided by the absolute figure of the first period multiplied by 100. So we can see that the change in a particular item is taken and is recorded as a percentage of that item's value in the first period. Here we can see an example. The figures in the statement of profit and loss are given for the years 2017-18 and 2018-19. As we can see, the revenue from operations is rupees 50 lakhs and rupees 75 lakhs respectively. The other incomes added to the same are rupees 1 lakh 25,000 and rupees 1 lakh. With this, the total revenue for the 2 years amounts to rupees 51 lakh 25,000 and rupees 76 lakhs respectively. The expenses for the 2 years are rupees 6 lakhs 25,000 and rupees 4 lakhs. With this, we arrive at a profit before tax of rupees 45 lakhs and rupees 72 lakhs. The tax thereon is deducted at rupees 15 lakh 75,000 and rupees 28 lakhs 80,000, thereby giving a final profit after tax of rupees 29 lakhs 25,000 and rupees 43 lakhs 20,000 for the years 2017-18 and 2018-19 respectively. Now let us do the calculation for the comparative statements. Firstly, as the first column indicates, we will calculate the absolute increase or decrease for the second year by deducting the first year figures from the second year figures. So, for revenue from operations, we deduct 50 lakhs from 75 lakhs. That is, 75 lakhs minus 50 lakhs is equal to 25 lakhs. So the revenues have increased by 25 lakh rupees. In respect of other incomes, we calculate the absolute change as 1 lakh minus 1 lakh 25,000, which is a negative 25,000. That means the other incomes have reduced by 25,000 rupees. The absolute change in total revenue is rupees 76 lakhs minus rupees 51 lakh 25,000, which is rupees 24 lakh 75,000. The total revenue has increased by 24 lakhs 75,000 rupees. The absolute change in expenses is 4 lakhs minus 6 lakhs 25,000, which is a negative of rupees 2 lakhs 25,000. So this means that the expenses have fallen in the second year by rupees 2 lakhs 25,000. The absolute change in the profit before tax is 72 lakhs minus 45 lakhs, that is 27 lakhs rupees. This means that the profits before taxes for the second year has increased on account of an increase in the revenue from operations, a decrease in the other incomes, and a decrease in the expenses. The taxes are at 35% for both the years. Given the absolute changes in the profits before taxes, the differences in the taxes for the 2 years is rupees 28 lakhs 80,000 minus rupees 15 lakhs 75,000, which is rupees 13 lakhs 5,000. The absolute change in the resultant profit after taxes is rupees 43 lakhs 20,000 minus rupees 29 lakhs 25,000, which is 13 lakhs 95,000 rupees. Now that we saw the absolute changes, let us now see how to calculate the percentage changes in the 2 years for every item. The percentage change is calculated by dividing the absolute change by the value of the corresponding item in the latest period and multiplying by 100. The percentage change in the revenue from operations is 25 lakhs divided by 75 lakhs multiplied by 100, that is 33.33%. This means that the revenue from operations from the year 2017-18 to the year 2018-19 have increased by 33.33%. The percentage change in other incomes is minus 25,000 divided by 1 lakh multiplied by 100, that is minus 25%. This means that the other incomes have decreased from the year 2017-18 to the year 2018-19 by 25%. The percentage change in total revenue is 24 lakhs 75,000 divided by 76 lakhs multiplied by 100, that is 32.56%. This means that the total revenue has increased from the year 2017-18 to the year 2018-19 by 32.56%. The percentage change in expenses is minus 2 lakh 25,000 divided by 4 lakhs multiplied by 100, that is minus 56.25%. This means that the expenses have decreased from the year 2017-18 to the year 2018-19 by 56.25%. The percentage change in the profit before taxes is 27 lakhs divided by 72 lakhs multiplied by 100, that is 37.5%. This means that the profit before taxes have increased from the year 2017-18 to the year 2018-19 by 37.5%. The percentage change in the tax outflow is 13 lakh 5,000 divided by 28 lakhs 80,000 multiplied by 100, that is 45.31%. This means that the tax outflow has increased from the year 2017-18 to the year 2018-19 by 45.31%. The percentage change in the profit after taxes is 13 lakhs 95,000 rupees divided by 43 lakhs 20,000 rupees multiplied by 100, that is 32.29%. This means that the profits after taxes have increased from the year 2017-18 to the year 2018-19 by 32.29%. This is how a comparative statement is prepared. Now, let us see the next tool which is used to analyze the financial statements. The second tool of analysis are the common size statements, also known as component percentage statement. In this technique, one item is chosen as the base item in the balance sheet and the statement of profit and loss, and then all items are stated as a percentage of such common base. So, a common size balance sheet shows the percentage of each asset to total assets or each liability to the total liabilities. Similarly, a common size statement of profit and loss may list items of expenditure as a percentage of net revenue from operations. Getting all the items as a percentage of one common base item helps to understand the key changes and trends in the financial position and the operational result of a company. Also, when the common size statements are prepared for successive periods, then changes in the percentages of particular items can be recorded for different periods of time. This helps an organization to understand why a certain percentage gets either favorable or unfavorable over a period of time. Since the comparison is made in percentage terms and not in absolute terms, this method is also helpful to make inter-firm comparison as well as an organization's performance vis-a-vis the performance of the industry that it operates in. Now that we saw what is a common size statement, let us now see how to prepare a common size statement. In the preparation of the common size statements, firstly, the absolute figures that relate to 2 points of time are listed. This can be done even for 1 year or multiple years. Next, one item in the relevant statement is chosen as the common base item. That is, an item either in the statement of profit and loss, if that is the relevant statement for which common size statement is being prepared, or in the balance sheet, if that is the relevant statement for which the common size statement is being prepared. Once the common base item is chosen, then all the items in the relevant statement are stated as a percentage of such base item. That is, each item is divided by the base item and multiplied by 100 to arrive at a percentage of such item in relation to the base item. Here, let us take an example. The absolute figures appearing in the statement of profit and loss are given for the years 2017-18 and 2018-19. As we can see, the net sales is rupees 50 lakhs and rupees 75 lakhs respectively. The cost of goods sold against such net sales is rupees 10 lakhs and rupees 18 lakhs respectively. After deducting the cost of goods sold from the net sales, the resultant gross profit is rupees 40 lakhs and rupees 57 lakhs for the years 2017-18 and 2018-19. The operating expenses for the 2 years are rupees 5 lakhs and rupees 6 lakhs. On deducting such operating expenses from the gross profit, the resultant operating income for the years 2017-18 and 2018-19 is rupees 35 lakhs and rupees 51 lakhs. The non-operating expenses that are incurred are rupees 3 lakhs and rupees 4.5 lakhs. and the resultant profit after deducting the non-operating expenses are rupees 32 lakhs and rupees 46.5 lakhs. Now let us do the calculations for the common size statements. Here we are choosing the net sales as a common base against which we will compute the percentage for all the items. Firstly, we will calculate the percentages for the year 2017-18 and then for the year 2018-19. The percentage of each item to the net sales is calculated by dividing the amount of such item by the common base selected, which in our case is the net sales, and multiplying the same by 100. For the year 2017-18, the percentage calculation for the first item, that is net sales, is calculated by dividing 50 lakhs by 50 lakhs and multiplying the same by 100, which is 100%. In respect of cost of goods sold, the percentage is 10 lakhs divided by 50 lakhs, which is the common base, that is the net sales, multiplied by 100, that is 20%. So it means that the cost of goods sold is 20% of the net sales for the year 2017-18. The resultant gross profit is 40 lakhs, the percentage for which is calculated as 40 lakhs divided by 50 lakhs multiplied by 100, which is 80%. This means that gross profit is 80% of the net sales for the year 2017-18. The percentage in respect of operating expenses is 5 lakhs divided by 50 lakhs multiplied by 100, which is 10%. So, operating expenses are 10% of the total net sales. The percentage in respect of the resultant operating income is 35 lakhs divided by 50 lakhs multiplied by 100, which is 70%. This means that the operating income is 70% of the total net sales. The percentage of the non-operating expenses as against the net sales is 3 lakhs divided by 50 lakhs multiplied by 100, that is 6%. This means that the non-operating expenses are around 6% of the net sales. The percentage of the resultant profit is 32 lakhs divided by 50 lakhs multiplied by 100, that is 64%. So ultimately, on a net sales of 50 lakhs, the company is earning a profit of 64% on net sales after deducting all the relevant expenses. Now let us come to the year 2018-19. The common base here again is net sales. For this year, the percentage calculation for the net sales is 75 lakhs divided by 75 lakhs multiplied by 100, that is 100%. Going ahead, in respect of cost of goods sold, the percentage is 18 lakhs divided by 75 lakhs, which is the common base, that is net sales, multiplied by 100, that is 24%. So, it means that cost of goods sold is 24% of the net sales for the year 2018-19. The resultant gross profit here is 57 lakhs. The percentage for which is calculated as 57 lakhs divided by 75 lakhs multiplied by 100, which is 76%. This means for the year 2018-19, the gross profit has reduced to being 76% of the net sales, which is 4% less as compared to the year 2017-18. The percentage in respect of operating expenses is 6 lakhs divided by 75 lakhs multiplied by 100, that is 8%. It means that for the year 2018-19, the operating expenses has reduced to 8% of the net sales, which is a decrease of 2% from the year 2017-18. In respect of the operating income, the percentage is 51 lakhs divided by 75 lakhs multiplied by 100, which is 68%. So it means that for the year 2018-19, the operating income is 68% of net sales, which is a decrease of 2% from the earlier year. The percentage of non operating expenses against the net sales is 4.5 lakhs divided by 75 lakhs multiplied by 100, that is 6%. This means that for the year 2018-19, the non operating expenses remained at a constant of 6% of sales, as was the case in the year 2017-18. The percentage of the resultant profit is 46.5 lakhs divided by 75 lakhs multiplied by 100, which is 62%. So it means that for the year 2018-19, the company is earning a profit of 62% on net sales after deducting all the expenses. This shows a 2% decrease as compared to the earlier year. So here we calculated all the items as a percentage of a common base item, that is net sales. Now we can see how various items have either increased, decreased, or remained constant in relation to the net sales, as we have taken all the items to a common size by taking it all as a percentage of a common base. Based on this calculation, a comparison can be done of the performance of two different organizations or also for the same company for two different periods of time. The third tool of analysis is the trend analysis. In this technique, the analysis of financial statements is done by computing the trends for the information which is collected over a period of time. These trends are then compared to draw meaningful conclusions. In trend analysis, using the data collected over a period of time, any upward or downward percentage changes in the selected data can be observed. It involves the percentage relationship that each item bears to the same item in the base year. This helps to study the behavior of the same item over a period of time, whether such item is showing an increasing trend or a decreasing trend or remains constant. With this observation, any problem that may exist in relation to such item gets detected. In trend analysis, firstly, one particular year is taken as the base year and its trend value is taken as 100. Once the base year is set, then the trend percentages for the other years are calculated as a percentage of this base year. That is, the value for the present year is divided by the base year value and multiplied by 100. Here, let us take an example. The sales and its corresponding profits can be seen for the years 2014 to 2018. As we can see, the sales for the years 2014 to 2018 are rupees 10 lakhs, rupees 13.5 lakhs, rupees 16.75 lakhs, rupees 18.81 lakhs, and rupees 20 lakhs respectively. Its corresponding profits are rupees 2 lakhs, rupees 3.15 lakhs, rupees 4.75 lakhs, rupees 6.5 lakhs, and rupees 7.5 lakhs respectively. Here, let us take the year 2014 as the base year and hence its value is set to be 100. Now, we have to calculate the trend percentage for the other years as a percentage of this base year. For the year 2015, the trend percentage for sales will be 13.5 lakhs divided by 10 lakhs multiplied by 100, that is 135%. The trend percentage for profit will be 3.15 lakhs divided by 2 lakhs multiplied by 100, that is 157.5%. For the year 2016, the trend percentage for sales will be 16.75 lakhs divided by 10 lakhs multiplied by 100, that is 167.5%. The trend percentage for profit will be 4.75 lakhs divided by 2 lakhs multiplied by 100, that is 237.5%. For the year 2017, the trend percentage for sales will be 18.81 lakhs divided by 10 lakhs multiplied by 100, that is 188.1%. The trend percentage for profit will be 6.5 lakhs divided by 2 lakhs multiplied by 100, that is 325%. For the year 2018, the trend percentage for sales will be 20 lakhs divided by 10 lakhs multiplied by 100, that is 200%. The trend percentage for profit will be 7.5 lakhs divided by 2 lakhs multiplied by 100, that is 375%. With this calculation, we can evaluate the trend that a company follows in its sales and its profits. From 2014 to 2018, the sales have gradually grown 200% to become double of what it was in 2014. However, the trend of profit growth shows that the profits have grown more than 3 times, that is, profits have grown 375% or 3.75 times of what it was in the year 2014. Such growth in profits may be attributed to various factors like achieving an increased efficiency in various departments and hence lowering of expenses, etc. The trend calculation helps an organization to study the behavior of various items, like in our example, we see the behavior and pattern of trend in sales and profits. The fourth tool of analysis is ratio analysis. This is a technique which involves firstly regrouping the data that is available in the financial statements. Once the data is regrouped, certain arithmetical relationships are applied to this data which constitutes of two or more items in the financial statements. This derives certain ratios that give meaningful and useful conclusions and is used to assess the profitability, solvency, and efficiency of an enterprise. This is just a little summary of ratio analysis. We will discuss this in detail in chapter 10, which deals with ratio analysis. The fifth tool of analysis is the cash flow analysis. This refers to the actual movement of cash into and out of an organization. This analysis too has its own objectives that helps a company in various ways. We will discuss this in detail in chapter 11, which deals with the cash flow statements.